can't just focus on physical occupancy, because we might take a property over that's 99% occupied, and then all of a sudden it's 90% occupied, but the collections that we've increased have moved the NOI up to considerable amount. And also some of those tenants may have not been paying when we took over.
Welcome to the Cash Flow Chronicles. I'm your host, Jonny Catani, and the founder of Catani Capital Group. For the last 2 years, I've been studying alternative assets and now help solve the problem of creating passive cash flow for creators, influencers, and busy professionals by bringing you 5 episodes a week of easy to understand education in the world of passive investing. What's up, guys? And welcome to another episode of the Investor Relations Real Estate Podcast. I'm your host, Jonny Catani, and I'm joined today by Ryan Gibson. Ryan is the Chief Investment Officer and co-founder of Spartan Investment Group. He has organized over $250 million of private equity for Spartan's projects. Ryan has experience managing the development of SIG's projects in challenging markets. For SIG, Ryan is responsible for investor relations and capital raises for projects. He is also a highly experienced commercial airline pilot. Ryan graduated from Mercyhurst University with a bachelor's degree in business with concentrations in marketing, management, and advertising. Ryan, welcome to the show.
Thanks, Jonny. Appreciate you having me.
Thanks. Yeah, it's great to have you. Like we mentioned offline, this rounds out the C-suite for Spartan, which I think is officially the first group that I've had all the top and even a few directors in that as well. We've had Lauren and a few others. So you guys are very open and willing to come on, which I appreciate very much. And we are stoked to talk about self-storage because, as my listeners know, I am obsessed with this asset class, as I know you guys are as well. So
absolutely.
But kind of take us back a little bit before. You're an airline pilot. What were you doing before and what led you to Spartan?
Yeah, so always been an airline pilot. For a while, I was an airline pilot for about 17 years and really enjoyed doing that. And always just had an itch to scratch with entrepreneurship. So was able to fortunately meet somebody that shared the same passions as I do in starting a business. And so that's when Scott and I kind of got together in DC as neighbors. And for years, we just worked on the business while we worked our respective jobs. And so it was a lot of work doing both. But at some point we said, hey, we're gonna jump in and do this full time. And so it took a few years to do that. It takes a little while to transition to full-time real estate, obviously. Some people jump right in, some people transition it over a period. So we took the latter, and we really enjoy what we do and the company that we've built. We just celebrated our 100th employee, so we're really excited about that. And we're excited about storage. We're excited about what it's done during this inflationary environment. We're excited about the performance it's had as we go into a recession. Some people say we're not in a recession, but we absolutely are by definition, in my opinion. And we like how it's performing now during the recession. So, as we like to say, it does great during downtimes and it does good during uptimes. So now's the time to be in it.
Yeah, I couldn't agree more. I also agree that we're in a recession. I mean, by the technical definition, which, I guess is now being redefined, but, that's neither here nor there. We don't want to get too far into that. But I love the story. If I understand correctly, your guys' first deal in Spartan was a development deal. That's true, right?
Yeah. Our first storage deal was a ground up just southeast of Seattle. And it not only was a ground up deal, but it was a very challenging deal where we had to go through a lot of entitlements and permits and wetland removal and things like that. So we're glutton for punishment, I guess, in that regard. So yeah, it was a ground up deal, and we've got it built and open now, leasing up. Super excited about that one, and really like doing ground up developments. We just finished another one and opened up fully at the beginning of August, just outside of Portland, Oregon. And but we also add on pretty much to 50% of what we own. So right now we have somewhere between 250,000 and half a billion square feet of self-storage going up, or half a million, I should say, square feet going up around the country. So we add on additional units to what we buy as a way to add value to our properties. So.
Yeah, absolutely. And there's a lot of that, it feels pretty common to have, you find these mom and pops, or even not even a mom and pop, just someone who had a bunch of land, built kind of the necessity, or maybe they have a bunch of parking space, whatever it is. What is that? Is it much easier to do the add-ons than to, like, obviously then brand new development? But in terms of the red tape, are, most markets pretty receptive to, kind of adding on?
Yeah, I would say that like anything development, that depends. There's been some deals where it's come with vacant land, but it comes with a lot of stipulations. Like, you may have to rezone that land. It may not be the same parcel, so it may be a residentially zoned piece of property that you have to go through a rezoning process. Some jurisdictions, like you say, kind of are grandfathered in, and you've already got the existing business, and they sort of just go along with the kind of existing use, look and feel of the property. And some jurisdictions, might have a moratorium on self-storage, but that particular development might be grandfathered in. So I would say generally, yes, the assumption could be that if you're expanding a property that already exists, it's easier than trying to develop the business from scratch. And there could be a variety of different factors that make that the true statement, such as existing utilities to the site, existing zoning, existing use, and just, it's already there. So how much worse can it be? Some things that might happen, though, when you do that is you might be required to bring the whole property up to standards. You might be required to redo, repaint, rebrand, re-landscape that existing site in order to add on to that site. So, I wouldn't say it's a straightforward walk in the park every time, but I would say that it's generally more easier than trying to go do like a greenfield development where there's no utilities, there's no existing business, and you have to go through a lengthy process to do so.
Yeah, absolutely. That makes sense. And it does feel, and you can obviously attest to this. Are you getting a sense that there are some markets now that are really trying to keep self-storage like no more?
Yeah, absolutely. There's moratoriums on self-storage everywhere. And I think the misnomer is that you can build these things everywhere, and you can't. There's some restrictions on it because people don't like the business for a couple of different reasons. They think it's going to look like a rundown building, and that they don't want it in their community. And the reality is a lot of these nice facilities that are being built today are beautiful. They look like high-end retail. The other thing is employment. We don't employ a lot of people at the property, so municipalities tend to want you to build something that employs lots of people. And lastly, a lot of jurisdictions really want more housing. So self-storage is not really the ideal thing for municipalities to have come into the community. So we've worked with the cities a lot with that. For example, on one of our ground ups, we put retail in the front at their request to sort of work with the jurisdictions on making it so they get a little bit of what they want, and we get what we want in the back of the property. So there's a lot of different things you can do, a lot of creativity, but generally, you really want to make sure that your first stop is to the local municipality to make sure that they're okay with what you're trying to do.
Yeah, absolutely. And you can get creative. I've seen conversions, same thing, right? Retail on the bottom, storage up top, just kind of whatever it takes to appease and that can work. And so that can, it's nice you guys have the infrastructure to do that. Obviously not everybody's set up to do that. So some markets, the smaller people are going to stay out of. But as we kind of are heading in this recession, this uncertain market, is anything, obviously a lot is changing economically, but is anything changing for you guys in terms of strategy, maybe markets you're no longer looking at? What does that look like for you guys?
Yeah, so I would say the biggest changes in interest rates. Interest rates are going up and things are getting more expensive to finance. And what we have to do is we have to package that into our underwriting. And we want to make sure that our underwriting is representative of the worst case future predictive yield curve. so that we can make sure by the time we put something under contract so it closes, that the interest rate that's underwritten is reflective of day one of closing, which can change, right? Even when you get under contract, interest rates might go up or down, but generally they're going up and will probably continue to go up through the remainder of the year. So we're underwriting that into our pro forma. So that's a big change. The other thing that's changing is lenders are less likely to fund your CapEx improvements. So there's some lenders that are saying, we know we talked about doing a CapEx funding for this particular investment, but we're pausing all CapEx investment until next year or indefinitely. So we've had to swap out some lenders. We've had to say, okay, well, we're sorry, we have to build. We think this market is still a good market to add on to this property. So we're going to find a new lender and just kind of recapitalize to a lender that wants to do the expansion. So there's a lot of changing things in the market right now. On the positive note, things are changing for the better from a rent perspective. So we just implemented about $184,000 per month rent increases across our entire portfolio. So pretty significant rent increases going into effect. And of the 20,000 or so units that have been raised, we've only seen about 4 or 5% move outs. So we're seeing really good occupancy. We're seeing really strong rental rates going up. So that's increasing our NOI. But with a rising interest rate environment, cap rates, we haven't seen a strong indication of cap rates expanding or getting worse, but they tend to follow the yield curve. And basically with interest rates going up, we're going to see cap rates start going up at some point. However, we have a rising NOI. So when interest rates eventually go back down at some point, if they do, maybe next year or the year after, we're going to be in a strong position with an asset that has a great NOI. And with cap rates maybe coming back down, that would really be just a nice value add. But right now we're underwriting everything with the higher interest rates and really just looking for those sweet spot deals that are receptive to negotiating based on the interest rates and where they are today. And what it's doing is it's slowing down our acquisitions pipeline. So we're not buying as much. We have to be a lot more selective with pricing it to, again, that future worst case scenario. However, the things that we are finding, we think are not only great deals today, but in the future will be even better if interest rates eventually go down. The last thing we're kind of doing differently is we're making sure that any loans that we get don't have a prepayment penalty, so that when interest rates, if they go down, we can swap them out in the future. And the other thing that we're doing is we're looking at fixed interest rate loans and not having a tendency to we're trying to avoid obviously any variable interest rate so that we can memorialize not having that interest rate risk as we go through the investment.
Yeah, absolutely. That's appreciate that insight there, because obviously things have to change, right? When we do have this rising interest rate, are you anywhere you're willing to take on some negative yield because you do foresee interest rates eventually going down?
Everything that not everything, but some of the things that we own will have a negative yield. We'll take something over that we know isn't profitable, like a ground up development or a very small self-storage facility that, based on the purchase price and the NOI in place, won't necessarily have a positive cash flow day one. However, there might be some vacant land that's in that we can develop on, and eventually, you add so much value to the investment that it gets a cash flow positive. So yes, to answer your question, if it's just banking on future predictive interest rates going down and only cash flowing without a deep value add, no, we're not on that side of the risk. So we look for deep value add investment opportunities. They tend to cash flow, but a lot of our stuff that we buy has a lot of work to do. We have a lot of turnover in employees. We have a lot of fixing up paint, cameras, drive aisles, capital improvements to do the investment to really get it positioned for success. And so that's where we really make the money. So when you look at something, that we buy at maybe a 5 or 5.5 cap, we're looking at cap rate reversion over the hold period. So that's really what's important to us.
Yeah, absolutely. That makes perfect sense. And you have to be willing to take that on. Has anything changed in terms of your conversations with investors and investor sentiment and helping them understand what this changing environment, does for, their returns and different things like that?
Absolutely. It's been an interesting year. I mean, we typically buy our investments with an acquisition loan and then refinance them into the proper long-term debt. And refinances have taken a lot longer than anticipated. So that's not typical for us. So we've seen some of our investments take longer to refinance into great debt, and in an interest rate environment that has quickly changed. We all knew this was coming, but last year, the worst case scenario has become the best case scenario of this year, right? So everything has gotten so much worse. And so I think we've just had to communicate that things are taking longer, and things might not cash flow as quickly, but you have to keep the 5 year to 7 year projected hold period in mind, right? A lot of the stuff that we bought late last year is only within the first 20% investment time frame, and it's there's still deep value add to put in place. So while there might not be as much cash flow up front, the investment is really positioned for success in the long haul, which is why we're really ultimately in this game is to turn these investments around and make them very profitable, and perform at a high level. So conversations have changed that way. And then, obviously we've changed our finance strategy a bit this year with making sure that we have financing, fixed rate, no prepayment penalty in place before we move forward on anything. And that's really kind of slowed down our acquisitions pipeline.
Yeah, it makes perfect sense. I mean, the last, probably 5 to 7 years, investors have just enjoyed just an absolute incredible run. And it takes time for that sentiment to change and to understand that, hey, you're no longer just going to be able to, throw a dart at the board and land a 2x multiple on an 8 pref. You got to shift,
Yeah.
we're going to have to value add, and it's going to take longer. And you guys obviously have an incredible infrastructure. What have been the keys for you guys? Obviously it's market dependent, deal dependent, but when it comes to, staffing and management, what have been some real big keys for you guys?
Yeah, so it's been hiring the best people, hiring people that have experience and fit the culture has been kind of our focus. It's been very challenging. It's hiring one person basically a week nationwide is a challenging process. And I think really making the investment in the employee and then finding the employees that are willing to make the investment in Spartan and be familiar with who we are before the interview process starts, and really being committed to being part of the team, and then recognizing that everybody's not going to work out, and then helping them kind of see their way out of the organization if this isn't a good fit. And so, we've had low turnover at corporate and high turnover at the property level, staffing, and that's a litany of reasons. So there is no silver bullet. It's really just know what your values are in the company and let those guide you through the hiring process, and just look for the best people and invest in them. And so we've done that time and time again, and I think our most success has been in embodying that culture of a values driven organization.
Yeah, absolutely. And that's one thing I certainly admire about you guys is how value driven you are. Everyone else I've had on buys into the mission, which obviously you guys know as you grow gets more and more challenging, right? The further away you get from sort of the founders and C-suite, the less of a priority the mission is for those people, right? They've got their own families and their own things going on, and it's more of a job instead of and so navigating that, I'm sure, can be challenging in the hiring process, especially now when there's jobs everywhere.
Absolutely. Yeah. And the mission is really important. And as like you said, culture, as it moves away from the C-suite, it really becomes the number one thing. And we are putting in weekly surveys to our team. We're asking for feedback, and transparency is a big thing for us. And part of the reason why we wrote the vision for our team, our vision is for our team to grow both personally and professionally, is because we really wanted to have every Spartan in a position where they could thrive in both work and at home.
Yeah, absolutely. I love that. That's awesome. And like I said, you guys have great values. And so as we kind of round out here, you kind of teased earlier, you foresee maybe in the next couple of years, interest rates coming back. Obviously self-storage is set up no matter what, right? It's needs-based. So in this case, people may be downsizing, great, self-storage. Market goes back up, cool, we're buying more stuff, self-storage. So it really sets itself up well. We don't want to say recession-proof, but certainly resistant. Pull out your fuzzy crystal ball. What do you kind of see here for the next 12 to 24 months?
I see interest rates continuing to rise. I see the Fed failing at harnessing inflation as they're mandated to by Congress. 9.1 to 8.5, that's great, but I see inflation continuing to go. I think the elections are going to be really interesting. I think it's kind of up for anybody to grab, but interest rates eventually will go back down. And I think the fundamentals of self-storage are unchanged. And everybody thinks, Americans have too much stuff, and that might be true, but really it's life event dependent. So, when you age out, we relocate, downsize, jobs move. I think as long as Americans continuing to have life events, which I don't think is ever going to go away, there's always going to be need for storage. And I think in the United States, we've made it very convenient for people to use self-storage, which is why I think it's so prevalent here, and growing, internationally as well. But I think here it's like, you do a move and that there's a storage facility right down the road that you can rent from. I always thought self-storage was a little ridiculous. I've never had a unit in my life until I had a life event. I had a couple of kids. I have to move things out of my house and do an expansion on my home. And that's a life event. And I think as long as these life events continue to happen, such as things like COVID, where everybody had to hit the road in their RVs, or they had that room in the house that now they had to work from. So now they have to clear it out, or they want to make a gym in their home now, and they just have some belongings that they have to move out temporarily or permanently. I think those fundamentals are always going to be there. So, and I think the demand is only going to continue to grow for storage over time.
Yeah, I completely agree. And I'm sure you probably saw Marcus and Millichap released a report, I think it was like last month or earlier this month, and like 75% of offices are going to stay hybrid and or still from home. So that room that got cleared out is going to stay cleared out. And, Americans don't like to get rid of stuff. You think of sentimental value, think of how many, baby boomers are retiring every day. And there's just a lot of really great data that points towards it. Obviously, you guys know. You mentioned international. Any chance you guys are getting involved in that, or you just kind of pay attention as
No,
you're involved in it?
Just paying attention. We get hit up quite a bit for it, but just focused in the United States and very specific markets. So
has that does that change as well with this changing economy, where you kind of ex-nay some markets just due to the change?
Our market philosophy has remained unchanged, which we predicted the tertiary markets, the bedroom communities surrounding major metros, to be where everybody's moving. And that's only further accelerated and further gave confidence to what we decided a long time ago with these markets. So for example, like we're buying a bunch of stuff in Bluffton, Raleigh, the Carolinas in general, Louisville, Kentucky, Florida. Those are all proven markets, where, people are leaving the East Coast, Jersey, New York, migrating down to those states. And the population is just absolutely booming in those markets. And it's a rising tide raising all the boats. And so we've always been focused on those markets. We try to stay away from the primary markets, the downtown metropolitans, because, again, the trends say that the bedroom communities are where it's at. And then also the REIT competition is a lot lower. So we don't compete up against Public Storage and CubeSmart, et cetera. But they say, the secondary markets of now are the primary markets of yesterday. So those REITs are going to eventually come out to those markets and gobble up a lot of square footage, which is great. And, I think what people, if you're thinking about investing in self-storage and you think about a tertiary market right now, it's right in the sweet spot, because you have rents that are not high enough to justify new construction, but you have a lot of people moving there and a really strong demand. So you don't see as many new project starts anymore in those markets, but you see very well occupied, high rents in those markets, higher than we've seen historically. So we're just right in the right time for self-storage, and we're right in the right markets, which I think is fantastic.
That's awesome. Yeah. I love that. Yeah. As I've gotten more and more involved, started doing my own underwriting, kind of the same thing. And I'm even a little surprised sometimes with some of these tertiary markets where you're like, oh, wow, I didn't even realize. And then you look at the economics and you're like, wow, 3% growth year over year. And, and it's some small town you didn't even know, but it's only 30 miles from a primary market. And you're like, okay, this actually makes a lot of sense.
Yeah, and we don't have a specific minimum for population in those tertiary markets, but we'd like to see a significant population within that 30-minute or 30-mile drive time. So, we're not, on a tertiary, I think means a lot of things to a lot of different people. We're talking about, within an hour or two of a major airport is typically where we go. Yeah.
Yeah, because ultimately, I was just listening to an economist podcast the other day, and they were talking about how some of these markets that really enjoyed, a lot of things through COVID are just kind of pretend, right? Like, your small town, Wyoming and even like Boise, right? People are eventually going to be like, okay, I actually don't really want to be here anymore. Like now that stuff's open again and I can go to LA or, I can do stuff in Seattle. They're like, all right.
Yeah. It was interesting. That happened with us. It was like, I during COVID, I was like, why do I live in a city? And then when COVID, started to get less prevalent, now we're going back to the places we used to go. And I'm like, oh, right, this is actually really cool. So, and I've talked to friends that, moved out of LA or moved out of downtown, and, some of them are gone forever, but some of them are like, okay, I'm bored now. I'm ready to go back. So.
Yeah. Makes perfect sense. And so it's really just paying attention to that. And like you guys, obviously the Carolinas, Florida, Texas, always going to be strong. The rent increases haven't really changed much, have they? I was looking at the reports and it still seems they're in the double digits in some of those.
Double digit year over year, which we've never underwritten double digit rent increases, market rate increases. I mean, we might buy a property that's 50% below market rates when we buy it, and then we'll just bring it up to market. But I mean, that is the market rate rent growth in storage has been tremendous. And, we had 12.7% annual growth during COVID. And then now we're up another 10% since then. So in the REITs just reported, we just did a blog on this on our website, the REIT growth data that came out, the NOI is up 20% on most REITs year over year. It's crazy. And, they put out these, we really follow the REIT data to kind of make our own forecast for a given market or just in general. And they put out, I think 10 to 12% projections last year and just completely smashed them. So this industry is it's continuing to grow. The rents are continuing to climb. And if you can find that right location in a great market, there's a really tremendous opportunity still. A lot of room to run. And, as you probably know, that only about 70% of these facilities are still owned by mom and pops. So still a lot of opportunity.
It's crazy to think that, because and obviously we're so involved in the industry that it feels like everybody's doing it.
Sure.
But when you actually break it down and you look at it, you're like, wow, there actually are, like I'm in some Facebook groups and all of a sudden you'll get some little thing in like, Podunk, Kansas, and you're like, oh, wow, there's a storage facility there and it's fully occupied. And so is that whole market. And you're like, whoa, okay. Yeah, there are.
Yeah, there's more self-storage facilities in the United States than all fast food chains combined. So they're in every market. Now, going to a middle of nowhere Kansas, we stay away from that type of investing. Not that it's bad for anybody in particular, but we kind of look at, again, kind of the tertiary markets that are in a lot of sense considered sort of primary, but to us, like Chattanooga, Tennessee, Tyler, Texas, hour and a half east of Dallas, or just kind of surrounding the Dallas surrounding bedroom communities. So Yeah, but a lot of opportunities still, like you were saying, a lot of mom and pop owned facilities in most markets still.
Yeah, absolutely. And are you finding with this shift that a lot of them are just ready to get out of the game just because of the, they don't really want to go through another one of these recessions and kind of that stuff?
Yeah, so really what it boils down to is the mom and pop built this facility 30, 40 years ago, and they have a low cost basis in the property. They paid a lot less for the land and the build. And at the time, there wasn't sophisticated revenue management and a lot of industry data. So their primary objective was to fill that facility up and keep it full, 100% physical occupancy with a wait list. And eventually the cash flow came, and it was so tremendous based on even the basis that they paid, that their goal was to just keep it full and have it be a hands-off business. So a lot of them just kind of took a snooze and just said, oh, it's full, I don't worry about it, there's a wait list. Well, meanwhile, operators are coming in, they're building facilities, they're filling them up, we're commanding really great rents. And so these little mom and pops are kind of sprinkled throughout those markets. And so we can come in and basically take over, and the customers that are in that property, we turn them over, or we raise the rents to market and they decide to stay. That's okay. But we do marketing, we do revenue management, we do our own property operations that take that property and really turn it into a high functioning business by turning over those lower rent tenants. And our focus is very different. Our focus is to squeeze every drop of revenue out of that facility versus keeping it. We don't really, occupancy matters, but it only matters to the extent that you can get the collections to the point where you can hit your targets or exceed them. So that's what we really like about it.
Yeah, absolutely. And I feel like you're constantly seeing, 75%, you're, 90% physical occupancy, but then, like 75% economic occupancy. And you're like, oh, wow, okay. And just like you said, same story, right? Yeah, we haven't raised rents in 10 years. And you're like, wow.
There's a property we just bought into the fund, our first investment in the fund. They haven't raised the rent since the 90s. So, and you look at the market.
Do you just go in and immediately to market for everyone, not just street rates, immediately for the tenants as well?
Yeah, so we have to follow the contract. These leases generally renew every 30 days, but some properties are on annual leases. Some of them are on 30-day leases. I don't know why they have money annual leases. It's weird, but just kind of old school mentality. And so we come in, we get everybody turned over to 30-day leases. And then as soon as the timing is right, so we bought this property in July, basically end of June. And so street rates, we cranked 90% increase in street rates, 90% the first day. And naturally, you're always going to have tenants turning over. So we had, I think, 30 new tenants move in the first month at that higher 90% higher rate. And then the existing tenants, we're going to do increases October 1st because of how the annual leases expire. And so we're going to have two waves where we do half the, somewhere around half the property, October 1st and the rest November 1st. So we'll bring them right up to market or thereabouts. So we'll have quite a significant bump in NOI at some point.
Wow.
Yeah.
And the fascinating part about that is logic would be like, oh, wow, your occupancy is going to go to, drop by half. But in reality, you look at the data, it's like 3 to 5% of people actually end up leaving.
Yeah. And this is the investor relations podcast, right? So investors, we want to communicate well to our investors. So one thing that we report on is physical occupancy. But that metric can't stand on its own. You have to consider economic, you have to consider collections, you have to consider what the NOI is doing, on a 12-month average look back. You can't just focus on physical occupancy, because we might take a property over that's 99% occupied, and then all of a sudden it's 90% occupied, but the collections that we've increased have moved the NOI up to considerable amount. And also some of those tenants may have not been paying when we took over and may have needed to go through auctions. So physical occupancy is just kind of a mirage of how successful something really is. It's an important piece of a larger metrics that you have to look at.
Yeah, absolutely. I appreciate that perspective, because I feel like so many people get so set on that physical occupancy number, and like you said, it's a part of something, but standing alone, it really doesn't mean anything.
Absolutely. Yeah.
I love it. Awesome. Well, as we wind down here, we'll jump to the final five. First question, best advice you've gotten from a mentor?
Best advice from a mentor would be just to always continue learning and improving.
I love that. Yeah. You really, that's the only way, right? Because the more you learn, the more you realize you don't know. What is it about your career that makes you feel like you're fulfilling your why?
My team. Yeah, giving them, a great place to work and supporting them in any way that I can.
Love that. That's awesome. Favorite non-real estate or investment related book?
Non-real estate, non-investment, Boys in the Boat, 100%.
Okay. I'm going to put it on the list.
Oh, you've got to read it. It's a great story.
Boys in the Boat. Okay.
Yep.
If you could have any superpower, what would it be?
Multiply myself.
You guys must talk about this.
We're all in the same. What was
pretty similar?
Oh, was
he?
he?
What did he say? He was like, I wanted to be, I can't remember exactly what he said. Something about like being matter so he could have any superpower he ever wanted or something. You know him. We talked about quantum mechanics and how he applies that to his business. And I was like, and then the gloss went over my eyes. He's like, I guess I need to find a better way to explain this. And I'm like, well, yeah, but also you need to understand not everyone quite has that same level of intellect, but it was fun.
Smart guy.
Yeah, he is. Cool. What's the best way for people to get a hold of you and learn more?
I'm on LinkedIn. You can search me, Spartan Investment Group on LinkedIn. Email is great, Ryan@Spartan-investors.com. And then our website, Spartan-investors.com, if you want to learn about our team and what we do. We put out a lot of education content on our YouTube channel as well. We like to just try to add value to anything that we can. So
I love it. We'll link those in the show notes, make it super easy. Ryan, thank you so much for all of your insight and perspective here. We love self-storage on this podcast, so thanks for joining us.
Thanks, Johnny. Appreciate it.
Absolutely. Thank you again for tuning in. Who do you know that wants more cash flow? Share this episode with them so you can grow your cash flow together. If you enjoyed the show, make sure you're subscribed on your platform of choice so you never miss a new episode. Go to KataniCapitalGroup.com to learn more.